Good evening, everyone. Time for part 4 on FOFOA's Blogspot silver article. What you are looking at right now is a pie chart. One of the pieces of the pie is marked in yellow and the other piece is marked in blue. Sometimes when you come across the opposition, you come across something that is so startling you don't realize it at first. If you recall back when Andrew Maguire was on the CFTC's commission and testified regarding, actually I don't think Andrew testified, but the person who brought him there testified. But there was an admission during that commission, and if you watch a lot of SGT Bull's silver videos, you'll see a video admission by Jeffrey Christian of the CPM group that silver is traded at 100 to 1 paper silver for physical silver. Well, if you remember back in FOFOA's article, we had this admission. Incidentally, many people seem to forget that COMEX is not a major physical silver exchange. It's a paper price discovery mechanism that handles less than 5% of the physical silver traded annually. So what I did to create this pie chart is I took the amount of physical silver traded annually, and we know that we're going to use 1 billion as our figure, and I was also adding up the COMEX volumes, and we were getting to the point where we were trading almost 1 billion ounces a day, because we broke down the contracts at 5,000, we broke down the volume. So if we take that amount, we take the amount of 1 billion, and then we multiply. We want to multiply times 250 to get a yearly. We get 250 billion. Now if you remember, we're going by 1 billion as the amount traded in a year, because that's about all the silver that's produced, and then it's used up every year. And 5% of that billion is 50 million. So we're going to take that 250 billion, we're going to divide it, 250 billion of paper ounces traded in a year divided by the 50 million of ounces actually delivered by the COMEX, and we get 5,000. So that's what this chart is. It's a 5,000 to 1 pie chart, and you can see, or you can't see, the yellow, because this amount is the paper silver, and the yellow slice of pie, which you cannot see, is the actual physical silver. So I really wanted to emphasize this. I emphasized it when I first came across it, but the 100 to 1 that Jeffrey Christian cited is that it's actually much worse than that. It's 5,000 to 1. In other words, this is one gigantic charade. It's not about silver. It's about pieces of paper called silver. That's nearly 100% of the market. So this, in my opinion, really is a blockbuster fact, and it comes through FOFOA's admission, and I just think that that is so telling that what's really going on in the COMEX is just a complete fraud. So let's go and continue where we were. We had just dealt with his dismissal of Ted Butler and his claim that Ted and people who follow him will be found to be dead wrong. Kind of spooky, the language that he uses, but we'll see why later on. So let's continue. Let's deal with another allegation which has been floating around, that JP Morgan inherited a huge naked short position in silver with Bear Stearns' acquisition. I'm not going to dwell on this for long. The fact that JP Morgan was indemnified by the Fed on unknown terms for losses on this acquisition make this a non-issue, in my opinion. If there are losses, I think we can safely assume that they will be picked up by Wall Street's best little buddy, the American taxpayer. Now, why he believes that it's a non-issue simply because it's backstopped by the government, I don't know. Because Bear could have collapsed because of silver. If you were there, and I was there, Jason Hommel's article came out Sunday night, Monday morning. That Monday morning, Bear Stearns opened up for $2 a share while it had closed Friday for 30. The Fed did something unprecedented. In my opinion, that was the point in time when all investors should have exited stocks for good, because you had the government declaring a stock to be worth a fraction of its free market value over a weekend without the stock trading. So, and this, if you think you're seeing shortages now, if you were around back then, there was no silver to be had the next day. So something huge happened in the silver market. It was not a non-issue. It was huge. And this is more evidence that it's actually the Federal Reserve and the government that's behind the silver manipulation, and that Bear Stearns or JP Morgan or whoever they want to use, their compliant banks that they use, which are backstopped, this is a huge issue, not a non-issue. This is a huge issue. So he likes to brush over that, but he actually, by doing so, he gives more evidence to the conspiracy. The central characters of the supporting cast. The main characters in this story are the bullion banks, miners, ETFs, refiners, mints, retail investors, and the silver industrial users. Now we have to look at these real quick. Bullion banks, there are no bullion banks in silver, because silver is not bullion according to them. They've demonetized it, and it's strictly used as an industrial commodity, and so they don't have any to dump. So we don't care about the bullion banks. We do care about the miners, because they're the ones who actually get it out of the ground. But the ETFs, in my opinion, they don't have any silver either. Probably Sprott and maybe the CEF in Canada. I don't know. It's still paper, but they probably have their silver. The refiners, the mints, and the retail investors and the industrial users. In my opinion, these are the two key players, the retail investors and the industrial users. I think what we're going to see is that the retail investors are going to get into a bidding war with the industrial silver users, and that is ultimately what is going to catapult the price of silver to the stratosphere. As this narrative unfolds, it should be quite obvious that the only silver market operators with the capacity to make this story come to life are the international bullion banks. All that would be required of the other market participants is that they behave predictably. Their cooperation would not be needed by a manipulator. Let's face it, the less people in the know, the better. Incidentally, if any reader needs an introduction to the precious metal fabrication and supply chain, Bron Suchecki of the Perth Mint has provided an excellent series of posts you can access here. The jewelry makers are peripheral to our story, except insofar as the rising gold price has resulted in the increased substitution of silver for gold in the fashion jewelry business. So this segment of the market has added to the demand pressure on the flow of silver as well. In my opinion, the gold jewelry market is much smaller and the official figures than the official figures suggest. As Jim Sinclair has often pointed out, gold jewelry in many Eastern countries is sold by weight and purity. It's wearable bullion, not simply a fashion statement. Miners have seen the price of silver rise to over $40 per ounce, while the MineWeb report linked above indicates that cash costs are currently $5.27 per ounce. Now, this is bandied about. We get this bandied about all the time. In fact, I just addressed someone who posted that on one of my videos, that, well, it only costs $5 to take it out of the ground, and my reply was, well, a car only has $1,000 worth of raw materials in it, so what? That's irrelevant. This figure is so deceptive because it's pulled out as a byproduct of other metals. It's incidental. Who knows how they're calculating this cost? This is just simply a bogus, completely bogus figure. And if it were only $5 to get it out of the ground, you would see people opening mines all over the place. But it's not. It's far higher than that, and they know that. Others estimate their average cost by the time the silver is on its way to the refiner at up to $15 per ounce. The cost estimates put out by miners are notoriously unreliable. Well, it's good that you admitted that. There are plenty of financial incentives for a mining company to understate their costs. Murray Pollitt discusses this issue here. The predictable behavior a corner operator would expect from the miners is a desire to lock in some of their profits on silver through hedging. If a corner operator also advised the miners, provided financing and banking services to them, and facilitated their hedging strategies, it would give the operator a huge edge, a vastly superior information feed compared to the other players in the silver market, and more opportunity to influence the directional flow of silver. A savvy corner operator might also see the writing on the wall in these high profit margins of the silver miners, a pointer to the use-by date for their physical silver corner. Over the last few years, silver ore bodies and old workings that were not economic for half a century have become financially viable. Refiners produce a range of products in addition to the standard larger bar sizes. They produce flake, shot, to meet the specific needs of their fastest growing and largest customers, the industrial silver users. Make no mistake, the industrial users are the most important customers in this market. The challenge of matching their output to the demands of customers with quite different needs makes the refiners a potential choke point, a supply bottleneck that a well-connected corner operator could exploit opportunistically. The retail investor demand for silver has also been growing strongly. It has been reported that last year this segment accounted for around 10% of total fabrication demand. Physical silver investors are price sensitive, but many tend to just accumulate over time, dollar cost averaging their original stash. Many of these investors are buy and hold folks. From a corner operator's perspective, retail silver investors help immobilize the stock, compete for the flow, and they are somewhat predictable. Institutional investment in silver generally flows into the ETFs, ETPs, and mining shares for a simple reason. Many of these investors are prevented from holding physical metal by their investment mandates. Even if they wanted to, they could not hold physical. Okay, well, it's not just their investment mandates. We already looked at our pie chart. And if you remember, 50 million was the number of ounces that we saw coming out of the COMEX on a yearly basis, remember? So let's take our 50 million times the current price of silver, and we get $1.75 billion. The value of that silver, the amount of silver that the COMEX delivers every year, is $1.75 billion at current prices. How can institutional investors invest in $1.75 billion of annual production? That's ridiculous. That's the size that some of the commissions and bonuses these people make. It's utterly absurd. They have to spend their money in the ETFs, the ETPs, and the mining shares because there isn't enough silver. So it's not their investment mandate, it's that the price of silver needs to go 100-fold before they can even get involved. I addressed this issue in one of my Office series, and you can go and watch that. I don't remember which number it is, but the main protagonist in there is teaching about the investment in physical silver, and he uses the phrase, silver has to go up, and that's what we're talking about. Silver needs to go up at least 100 or 1,000-fold before institutional investors can even get involved in the market. I'm talking about real silver, not fake silver. So this is huge stuff here. Even if they wanted to, they could not hold physical silver. I concede that mandates and the laws that give rise to them can be amended in order not to get bogged down in a will to, will not argument. I hope others will concede that I have described the status quo. Overwhelmingly, pension funds and their ilk tend to be on the long side of markets they invest in. You know what I'm about to say, don't you? They are predictable. You're probably getting sick of the word predictable by now. Just try to imagine that you are a character in this story too. Imagine for a moment that it's real. Behaving predictably might not be such a great idea if you are attempting to trade or do business in a cornered market. Ed Harbus, CEO of Perth Mint, explains here why running a mint is such a challenging customer-driven business. Despite unsubstantiated allegations to the contrary, the large mints, by their actions, can be seen to be honest, conservative, generally prudent, and not inclined to speculate. I don't know about that. I've generally found that to be the case, but I don't know. Didn't we recently hear, or not so recently, maybe a year or two ago, about the Royal Canadian Mint all of a sudden having millions of ounces of precious metals disappear they couldn't account for? I remember some similar story at the Perth Mint. I'm not sure. You'll have to try to find those articles, but Jason Hommel has also done a number of articles on some of the certificate programs at Perth and others. I'm not going to say, because I don't know, but I'm not going to accept his word for it that the mints are honest, conservative, and generally prudent and not inclined to speculate. I don't know if that's the case. The mint's demand for silver is ultimately driven by retail and wholesale customers. Mints tend to have a feast or famine sales pattern that makes it difficult to forward plan capital expenditure programs. They certainly cannot expand their overall production capacity quickly. Hence, they are also highly predictable and another potential choke point that could be exploited in a corner. Industrial silver users are the single biggest market for silver, purchasing approximately half of the annual flow of silver. As mentioned earlier, this large market is growing strongly. A corner operator can rely on industrial users for profits when prices are rising. Here's why. An important factor to understand in the case of silver is that demand from industrial sector tends to be quite inelastic. This means that buyers have few options and have to pay at prevailing prices. Now, we pointed that out in a number of places. One of my office series is about the inelasticity of both supply and demand in silver, and FOFOA has confirmed that. In this story, the industrial users would be the main target victim of a corner operator. When production bottlenecks occur at the mints and or refiners, a corner operator could take advantage of the ignorance of most retail investors and play on the widespread belief that there is a shortage of silver. I'll return to this topic later. The corner operator could also rely on all of the dealers to take up any rumor or urban myth that sells silver. With premiums like these, the dealers have every incentive to support the hype, hope, and hysteria that often surrounds the retail investment market these days. I'm going to stop there. We're going to go into the ETFs in part 5, but I wanted to point out about the bottleneck. Now, if you've been following silver like I have, as I point out, in 2008 we had tremendous shortages and bottlenecks. We're seeing those come back, and the mints are generally run by the governments, although there are private mints, and they are a for-profit business in the sense that they need to make money to keep going, but we have seen delays and shortages. For example, let's look at the Silver Eagle. We've had ongoing delays and shortages in the Silver Eagle for 3 years. Now, you don't see any business out in the free market system that operates in that manner. Eventually, they would get online more ability to produce whatever they're selling. After all, they're making a profit. You don't see a business out there where people are busting down the door trying to get the product, and the lines are long, but they just stay in queue for 3 years. That doesn't make any sense. That's not how the market operates. I don't care if it's Chipotle or Five Guys or whoever the business is. If there's a huge demand for that, they're going to open more. They're going to keep opening more until they satisfy that demand. But the mints aren't doing that. So there's something else going on here. So we'll take that up in part 5. I wanted you to look at your pie chart again. Think about this bombshell. This is bigger than Jeffrey Christian. This is FOFOA admitting that the COMEX is trading 5,000 ounces of paper silver to every 1 physical ounce that they deliver. In other words, the COMEX is irrelevant. In other words, the COMEX is a fraud. The COMEX is a scam, and ultimately the COMEX will be discredited and dismissed. And we'll talk to you next time.